ARM Holdings, ticker ARM, is down nearly 6% today. Now, obviously, this is the stock that IPO'd on Thursday, probably the biggest IPO we'll have had in a while, and probably going to be the largest one we will have for a while. Now, what are the key things to be paying attention to? So quickly, again, in recent IPO, we're not going to really have that much of key levels. We can see today we almost tested the all-time low. Obviously, that's at 55.54. Kind of bounced just before, and we're getting a bit of buying pressure. If we come down to retest this, I'll be looking at more for a break on that second move. And that may provide more of a day trading opportunity. If we break below it, retest it, then could look to short it on that second move. So that's kind of what I'm paying attention to, is kind of just quickly to draw technical levels. But it's more the trade plan I'm more excited for on the stock like this. So obviously their options did launch today. And normally on these kind of stocks which are going to be super volatile, I was assuming the options were going to come out and be a lot more expensive than they were. However, it's come out and really they're not too bad. So obviously the closest to expiration is 32 days out, so 20th of October. And you can see the premiums aren't anything crazy, which I thought was quite of a surprise. So the way I'm actually looking to trade this, and my trade plan for this, is a straddle. Now, looking at two different ways to trade this, or well, they're both straddles, but just different strikes. But we can see right now going to cost us just under $800 to take a single contract or a single straddle long. So again, this would mean if we didn't move from where we currently are, we would basically go and end $800 in the loss. Obviously, if you push to either side, you start to lose less and less. Now, with this, the break even turns at $65 or just above, or about $49.50. Now, that's why I quite like this, because again, recent IPO, we're currently sitting around $50, or what was it, $57. So is a move to $49 or kind of $60 all that crazy? No, not really, especially within the next 32 days. I think this move is very likely to happen, and that's why I'm looking at the straddle, because I'm probably not going to hold it to the expiration, but seeing a move down to, kind of the low 50s, high 40s, this week, next week, don't think that's all that extreme to say we would see that. Or again, even a move to the upside. I think the downside move is more likely, but if we did get the upside move, again, a move above 60 or so, is that going to be all that unlikely to see? No, not really. So that's why I like the look of the straddle, because again, we can find that risk around $800. Above 65, we start making money. Say it goes to $70, so kind of where we hit on that Friday. It's going to be up about $450. And again, if we go down to say $45, you'll be up $440 as well. So probably not the best from a risk to reward standpoint, but I think there is just a high probability of the trade coming off, and that's what I'm looking at it. And again, we can kind of reduce that risk tiny or slightly if we want to go for a bit more of kind of delayed straddle. So what this means is there's more of an area where you take your max loss. So you can see between $55 and $60, you take a max loss of around $580. However, for that kind of having a wider area to take a max loss, what it does mean is the max loss is lower. And again, it does kind of widen the break evens out slightly more. But it does mean now from around $66, you'll be in the profit, and to the downside, anything kind of below $49, you'll be in profit. So again, looking at the same thing, if it goes to $70, you'll still be up about the same at around $420. And again, if it goes down to 45, you'll be up around $420. So this could make more sense from a risk to reward standpoint. And it's actually probably the way I'm going to trade this, because again, I don't think it will kind of really even stay within this range looking a week or two down the line, and especially not 32 weeks down the line when this contract finally expires. So that's my game plan on ARM. Let me know what you're looking at, and if you're looking to do a similar sort of strategy.